Welcome back. So today we're looking at an analysis of TLRY brands, specifically the volatility after its reverse stock split. The report argues that the current panic selling is really overshadowing some big opportunities.
Right.
And a key theme in this analysis seems to be the institutional opportunity, which feels like the right place for us to start our assessment of the document structure.
That seems right. The report does a good job of, identifying what's causing the volatility and what the underlying investment case is. So our goal is really to give some high-level feedback to maximize its impact.
Okay, so let's jump right in. The first point really has to be about that central bullish argument. The primary bull case, this institutional green light, it just needs more foundational support to shift it from a theoretical opportunity to something that feels more like an established probability.
This is excellent at laying out the mechanics of the situation.
Yeah, what I really like is the clear explanation that, being priced over $5 now means TLRY is actually investable for a lot of these huge funds.
Sure, the ones that were locked out before.
Exactly. That eligibility piece is defined perfectly. It sets the stage.
It does. But we have to look at the gap between being eligible to be bought and the certainty of being bought.
Right.
The report asserts that at, say, $7 plus, TLRY is back on the radar for big money. And the implication there is that these massive buyers will step in.
And stabilize the price.
Exactly. And that jump from just a possibility to what feels like a near certainty, that's probably the biggest vulnerability in the argument right now.
I can see that. It's an assertion about the future that really needs something concrete to anchor it. The weakness is just assuming that market access automatically means a flood of buy orders.
Yes.
If I'm a portfolio manager reading this, I need more than just the $5 mandate is met. I need to understand why they'd move now.
Precisely. So the suggestion here would be to integrate some historical context, some kind of precedent for how institutions behave after a reverse split, maybe in a similar sector.
To provide some external validation.
Exactly. But maybe even more important, the analysis needs to go beyond that simple price barrier and get into the weeds of actual index constraints.
You mean the index inclusion rules? Why is that detail so critical here?
Well, because institutional buying isn't just about the price tag. It's about, structural things like liquidity. A lot of funds have those $5 rules, sure. But a Russell or S&P index, they have other requirements.
Float characteristics, daily volume thresholds, things like that.
Things that may or may not be met right now. And if you ignore that second hurdle, the whole argument feels a bit thinner. The stock has to have enough liquidity so that a big fund can buy in without, moving the price against themselves.
Which is a totally separate issue from the minimum price. So if the analysis could confirm whether TLRY is getting close to meeting those other constraints, the whole case becomes exponentially stronger.
Absolutely. And for a concrete example, they could just briefly analyze a similar stock.
Show what happened to their institutional ownership after a reverse split.
Yes. Something like, in a comparable case, institutional ownership went up by Y% within 60 days, and show it was driven by these mandates. That gives the argument some real empirical weight.
Okay, so strengthening that institutional anchor is step one. That flows pretty naturally into the next point, which is how the analysis handles external threats.
Risk mitigation.
Right. So while the analysis correctly identifies the fear over tighter U.S. hemp regulations as a driver of this panic, the report really needs to fully integrate that downside risk into the overall assessment.
You have to. You can't just introduce a major threat and then sort of wave it away. It just lingers in the reader's mind.
Well, that's what it feels like. The report notes that 8 to 10% dip was partly driven by fears about the U.S. closing that loophole for hemp-derived THC drinks.
And then it immediately shifts.
Immediately. Right to the silver lining section, highlighting growth in Germany and Panama.
And that's the weakness. That structural shift creates a gap because it doesn't quantify how dependent TLRY strategy actually is on that specific U.S. segment.
Right.
So by not tackling it head-on, the reader is left wondering, okay, is this international growth enough to offset a potential U.S. problem?
It's treating a big regulatory risk like it's just background noise, instead of a material threat that you have to counter with hard evidence. And we know the market hates a risk it can't quantify. That's part of what fuels the panic selling this report is trying to fight.
Exactly. You have to bring the solution right next to the problem. So the suggestion is pretty straightforward. Introduce a brief, focus subsection that addresses management strategy for dealing with that U.S. hemp risk.
And explicitly frame that global growth as the diversification that offsets the U.S. headwind.
Precisely. Frame the international success as the defense mechanism, not just the separate piece of good news.
So how do you make that actionable without getting bogged down in too much detail?
The most direct way is just to quantify the exposure. Acknowledge the size of that hemp-derived segment, if possible, relative to the, $821 million in projected revenue? Even a quick note saying that segment is, say, a single-digit percentage of global revenue. If that's true, that would dramatically reduce the perceived risk. It calms the anxiety.
And then the structural fix you mentioned becomes key.
Absolutely. The real improvement is resequencing it. You take the global growth engine data, Germany, Panama, and you place it immediately after the discussion of the U.S. regulatory risks.
So you connect them directly.
You use the international diversity as the direct structural hedge. It becomes a very clean argument. It says, here is the problem, but here is the guaranteed diversified defense.
That sequencing is really effective. It forces the material to confront its own counterargument and neutralize it on the spot. Which actually leads us perfectly into our final point, which is all about optimizing the persuasive structure of the evidence.
Yeah.
Resequencing the core evidence, especially that definitive achievement on cost savings, could seriously enhance the report's immediate impact.
This is all about pacing. It's about using your strongest facts to land the biggest punch right at the start of the bull case.
Okay, so the silver lining chapter, right now it leads with the institutional green light. Then it lists Project 420, the cost savings, second, and then the global growth engine third. The evidence itself is good.
It is, but it's missing a huge opportunity by not leading with its most concrete achievement. The weakness is that the strongest, most measurable piece of news, that they've already hit $20.6 million in cost savings, is buried after the much less measurable institutional green light.
That's a good point. Institutional eligibility is a potential market dynamic. It's external.
Right. But cost savings, that's an internal achievement. It's verifiable. It's real money.
So by leading with the external opportunity, the analysis feels less grounded in what management has actually proven it can do. You want the reader to see what the company has done before you talk about what the market might do.
Exactly that. You want the most definitive proof of success to hit the reader first. So the suggestion is simple. Elevate that Project 420 section. Make it the very first point in the silver lining.
Use that concrete financial metric as the foundation.
Yes. And then the other points, the institutional access, the global growth, they can build on top of that already established fact of improving profitability. It just creates a much more logical, robust flow.
And that also helps with the psychological part of this report. You know, the goal of countering panic selling. When people see a reverse split, they often feel like management is failing.
They question their competence. Yeah.
But if you lead with $20.6 million in validated savings, that immediately rebuilds confidence. It says these are serious operators regardless of stock price mechanics.
That is the ultimate goal here. So, just to be clear, we restructured the flow to 1. Project 420 savings, 2. Institutional access, 3. Global growth.
It frames the company as fundamentally leaner first.
Which then justifies why institutions would want access second and why the international growth is so critical third.
And how do we make sure that point on efficiency links all the way to the end?
You can use that Project 420 status, the $20.6 million already saved, to build a stronger bridge to the final verdict. Don't just list it as a fact. Link that specific internal efficiency directly to the company's big goal of achieving positive free cash flow regardless of U.S. legalization.
So the conclusion rests on a measurable financial bedrock that the company built itself.
Exactly. It's all within their control.
Okay, we covered a lot of ground there. The goal was really to maximize the impact of this analysis report. We focused on 3 main areas. First, solidifying that institutional thesis with some concrete historical context and looking at market constraints beyond just the share price.
Mm-hmm.
And then we talked about that structural hedge against the U.S. regulatory risk, which means quantifying the revenue exposure and tactically resequencing the international data to act as the immediate counterpoint.
And finally, we suggested optimizing the whole sequence of the argument by elevating that internally controlled Project 420 data to lead the bull case. It just gives the entire investment thesis a stronger, more measurable foundation right from the start. Yeah, these suggestions are really just aimed at maximizing the analysis's impact and its robustness.